My name is John Howe-Wemett. I am the financial planner at Generation Capital Management. I am joined today by my good friend Eric Dauphin from Dauphin Fantacone CPAs. Can you say hi, Eric?
Hi, everyone. Yeah, thanks for having me, John. This is quite the experience so far.
Yeah, absolutely. So you can see that we are not in our usual office. We've decided to step up a little bit and do an actual studio here. Eric is in town. He drove all the way down the thruway for us, and we're incredibly excited to have him here and face to face instead of over a Zoom connection. So it's really nice. Thanks for doing this, Eric.
Yeah, thanks for having me.
Yeah, absolutely. Anyone who's watched our streams in the past knows that you're a regular contributor. Eric and I work together incredibly well. His insights are very valuable to me, very, very valuable to some of our clients. So we're very happy to connect and work together. Just want to let you know that the information shared today is just for educational purposes. It shouldn't be taken as advice about your specific situation. If you want some advice about your specific situation, you should talk to your financial advisor, your tax accountant. And if you don't have either of those, feel free to reach out to Eric or myself.
Yeah, I'll give a second disclaimer. My partner is one of the smartest tax brains I've ever met, so that's why he's back at the office doing that, and I'm here. So we'll do the best we can.
Well, the topic today is we want to talk about some smart tax moves that we can take kind of for ambitious professionals specifically, but also in general. I think a lot of these tips are going to apply to a lot of folks, but specifically what we're interested in is how to make your dollar go further, right? We want to keep more money in your pocket than in the government's pocket because we think that maybe you're a little bit better at deciding how to spend your money than the government is. So if there are ways within the tax code that we can help you figure out how to do that, then that's kind of our goal today, right, Eric?
Yeah, sounds right.
Yeah, absolutely. So I figured we'd start off with 2024. So right now it's tax season. We're all kind of thinking about how we can save some money on our taxes for last year before the April 15th deadline. What are some of the things that you're thinking of right now when you're working with clients and advising clients?
Yeah, so, given it's already filing season, the year's ended for 24, what we look at is the typical things, you and I talk to clients about the IRAs, the Roth IRAs, backdoor Roths. My personal favorite is the HSA. So, I'll definitely give that a shout out. But, the two things I want to mention is it sounds nice to save money for the past year, but it's really a last resort. So these things that sound simple, they're complicated, right? There's income limitations, contribution limits, all those things. So even these simple things, if people try to do them on their own, again, without an advisor, without a professional, even these are getting difficult, right? Regulations, just more and more. So, definitely work with a professional to do these. And then the second thing is, like I mentioned, it's a last resort. So the best scenario is to work with your professional all year round. There's a lot more options throughout the year than there are when we talk in March or April. And, the best firms make time for their clients during that time. But I would say the majority of professionals are so busy that, you may need to file an extension or you may need to just pass on the tax savings for that year because you're not going to have time to implement the right strategies. With that said, of course, there is time for IRAs, contribute that by the filing deadline. Again, make sure you're within the income limits for both, the IRA and the Roths. I always say work with your financial planner like John for the backdoor Roths. I don't, we file the forms, but, he's the one that kind of holds our clients' hands and walks them through that process and, really helping the clients understand what they're doing as well.
Yeah, absolutely. And part of my process, so when we're working together is when we have a client who's kind of on the cusp of being able to make Roth contributions or they're on the income threshold of being able to make a straight Roth IRA contribution versus a backdoor Roth contribution is, I work with Eric to kind of figure out where we are in terms of doing like an initial look at the tax return. And then once we have an idea of what the actual income situation is, then we can talk about implementing either the straight Roth contribution or doing the backdoor Roth. And there are some caveats that you need to be aware of when you're doing the backdoor Roth as well. So as Eric said, it's important to at least understand everything that's going on with your tax situation when you're looking at doing these strategies. But the most simple thing that you can do is run it by professionals. If you need a second look, there's ways to have a second look done. One of the things that you mentioned is the HSAs.
Yeah.
I love HSAs for previous year tax planning because they don't require any. You don't have to be concerned about income limits.
Right.
Right.
Yep. Yeah. And this is one, I do myself, always done it, since I had health insurance. So if you have that high deductible plan for 24, you can contribute up to that single or family max depending on your health insurance. And you can do that up to the filing deadline. And they call them triple tax advantage or triple tax free. So you get that deduction putting it in, it grows tax free. And as long as you spend it on medical, it comes out tax free.
Yep.
The other thing you'll see is people talk about, it's a great retirement vehicle or you can even use it prior to a retirement vehicle because, you're not paying payroll tax when that comes out of your paycheck. So it's really additional savings and additional money you're putting away. So long as your HSA can invest those funds,
Right.
That's a big caveat to that, of course.
Mm-hmm.
So these are awesome. Every year I sit down, do my return, March or something like that. And we look at, have we contributed already for that year? How much? And then, of course I run the calculation of how much it saves you, but roughly whatever you can put in before the filing deadline, multiply that by your effective tax rate. And that, that's going to be your cash savings.
Yeah, absolutely. And what I like specifically about that is that it gets you out of a scarcity mindset and into more of an abundance mindset with your money. When we're in the earlier stages of our careers, we're concerned about having cash available to us, and that's a valid concern. But when we get to kind of the later stages of our careers and we're saving more, we're in a more of an accumulation phase. I think it's important to remember that just because the money is moving from one pocket in your pants to another pocket in your pants doesn't mean that you're losing the money, right? Just because you can only use the money for a specific thing doesn't mean you can't use it at all. And it's better being in your pocket than than kind of leaving your entire net worth, right?
Yeah, and I think it, helps you think forward as well to the next year. A lot of people, if you're having a child or you have surgery scheduled, things like that, you're going to spend the money within the next 12 months, right?
Mm-hmm.
So it's not a big time value money calculation for them. It's not, I'm stocking it away forever. It is, I'm going to use it, right? I'm using it soon.
Yep.
Why not get, $2,000-$3,000 tax savings today?
Absolutely. What about for self-employed folks? I know that a lot of my clients are self-employed. I know that you work with a lot of self-employed people. What are some things that they can do for 2024 still?
Yeah, so the number one thing I tell people is, have good records. And so, there's some things you can only do throughout the year, and we try to set them up for success in the future. But, ensuring that if they have a business bank account, it's reconciled, are there personal, things that they paid for personally for the business that need to be accounted for.
Mm-hmm.
Of course, we have the retirement options as well. We have SEP IRAs and solo 401ks that, we'd work with John to implement if they don't have them already. And then again, those can be made up to the filing deadline. So those are big, but really just going back, taking the time, you'll find a lot of businesses kind of rush to get that return done and, put some stuff in a spreadsheet. But, just giving that extra thought, I mean, half the time when we do get those summaries, our tax fees might be missing, something like that. And so taking that extra time to make sure you're getting all the deductions, because that's just, you're leaving money on the table.
Yeah, absolutely. To the point of the SEP IRAs and the solo Ks, those are fantastic accounts for a lot of self-employed people. But one of the things that I work with clients when they come to me and they say, hey, we need to set up a retirement account, we're self-employed, we need to do this. I say, okay, well, it's great to set it up, but we need to know how much you can contribute, not even from a tax standpoint, but from a cash flow standpoint, right? Do you have adequate emergency fund? What's your income? What are your expenses? And that's part of the process that I go through with all of my clients to make sure that they fully understand that. Because a lot of some advisors might just say, okay, great. Well, you've got the cash. Let's set up a SEP IRA and we'll just put the max in for you and not be concerned about the client's cash flow situation or emergency fund situation.
Yeah.
Right.
Yep. So that's a good point. So we run into this a lot. In the past, we've had advisors tell us, we've had the client contribute throughout the year to their SEP, and we get to the return and, they didn't make enough to contribute that. And so that becomes such a headache. So, people do try to automate things throughout the year, which can be good, especially with something as straightforward as an HSA. The max, no income limits. That's an easy one. But when it comes to, SEP, I prefer to wait till we have that return prepared, especially on a business that, can fluctuate pretty wildly.
Mm-hmm.
And I would say, a lot of the clients we talk to, a lot of people listening, probably it's rare to have your CPA communicate with your advisor, unfortunately.
Yeah.
But
it is.
But really, I mean, like a strategy like that, it can't be implemented correctly without both sides.
Right.
Because if you're managing not only that retirement vehicle, but you're also managing their financial plan, like you mentioned, cash flow, right? That's not something we typically work with on individual clients. That's more their financial planner.
Mm-hmm.
So if it was not in their plan to spend, to put $20,000 into a SEP, we're not going to know that.
Right.
And so we may tell them to do that. And some clients, good clients, typically listen. So they may do that without questioning it.
Mm-hmm.
But it, again, we threw them off their financial plan, which typically overall should be more important than just the current year tax savings.
Yeah, and that is one of the things that I kind of learned early on in my career is don't let the tax tail wag the dog.
Right.
Right. Like you can be smart about your tax situation, but it shouldn't be the end all be all.
Right.
It should be part of an entire strategy for your wealth. And we see this with some people managing their investments in a way that they think is tax optimized, but really they're missing out on significant opportunities. So it's important to keep perspective when you're going through all of this.
Yeah, of course.
Yeah.
Yeah, we see that a lot too. I mean, the people that, they'll buy the car, to get the business write off, and then, they struggle to put away for retirement, or, I always say having cash at the end of the year, one of the easy last minute tax moves you can do is if you have to have cash, right? Because whether you implement these strategies or not, you either need cash for the tax or you need cash for the strategy. But typically you need cash. So an easy thing to do throughout the year too is just, spend less than you make, whether that's of course personally or in the business, especially. It opens up a lot more doors for overall savings. It's a scenario where it really takes money to make money on some of these things. Yeah,
absolutely. And that kind of moves us into the next thing I wanted to talk to you about, which was mistakes that people often make that you're seeing in your practice. Is people being cash strapped one of the things that you've kind of seen a lot to kind of prevent them from being able to implement a lot of these strategies?
Yeah, definitely. So we'll have clients I've had clients in the last week or two come to us and say, hey, I made this much money and there's going to be a lot of tax. What can I do?
Yeah.
And then you're like, well, you can do this. And they're like, well, I don't have that much money. So it's just kind of almost a circular reference. So I think the biggest thing, which you've already probably heard me talk about, is people not communicating with their professionals, whether that's their CPA, their advisor, their attorney, and sometimes all three, sometimes all three on the same call.
Right. Which we do sometimes.
Right.
Yeah.
So, you can, again, I say you can make all the money you want in your business and, you're working hard, but if you don't have, life insurance, if something happens, what good is that? You're not protecting what you're doing.
Right.
And then, again, they're coming to us with, a tax problem and a cash problem, and, where's their advisor? And I would say 50% of the time they don't have one.
Right.
And then the other 50%, we can't get on a call with them. So biggest mistake overall is just not communicating throughout the year. So we're here all year. We typically don't, we don't charge extra fees for an email or a call. So, people that do start a business or, do something unique that year, reaching out throughout the year can give us time. And we're happy to do that in June.
Right.
Of the current year. It gets very difficult to do that after the year ended. And it's, we're sitting in March and April and need to get that return filed.
Yeah, one of the things that I've heard you say, and I guess I had thought about it, but I'd never really heard it explicitly said, is you have made it explicitly clear in our conversations that the tax year starts January 1st.
Oh, yeah.
Like people think that it starts, so they think that 2024's tax year started January 1st of this year.
Right.
But that's not true. It started January 1st of 2024, and it goes until goes until the tax filing deadline for your 2024 return, right?
Yeah.
Because there's stuff that you need to do starting January 1st of that year, and then there's stuff that you can do after the fact.
Yep.
And so that's so important for people to remember, is that as you're going along, it's important to have that open communication.
Right. And to go back, the first stuff we talked about, the last minute 2024, like, it sounds good. It's obviously it's a nice clickbait for you, John, for us, but it's so limiting,
Right.
I mean, there's a reason we have a few points, because there's not that much you can do, especially if you're not a business owner, if you're a W-2.
Yep.
You're really stuck to that tax year, aside from those few items. So, I think I had said before, it's like, sitting in the next year and asking a personal trainer to help you lose weight in 2024. Right? They can't do it, unless you have a time machine. So you have to start in January. Talk to your professional. We do talk to a lot of our clients when filing the prior year return. If we do see some of these mistakes, things they could do better, that's when we want to talk about 2025, for wage earners, even if it's just adjusting your W-2s, because you're looking at either a large tax bill or even a large tax refund.
Yeah.
We'll want to adjust those for 25. But, start thinking about it January 1st for sure.
Mm-hmm. What are some of the other common mistakes that you see people make with their taxes?
Well, I guess to go back to that, another thing that you can start doing is, like, what I do is, of course, my wife and I sit down and we go through, do we want to change retirement for that year? Do we want to increase the HSA? This year we started doing a dependent care FSA. Mm-hmm. So those things that are kind of automatically done for you in a positive way, do you want to keep those rolling, or do you want to do something different? Or maybe you want to back down on your retirement. You need more cash that year for some reason. So always make those decisions up front, because, the later you get into the year, the less impact it's going to have on those overall.
Yeah. And that's another thing that I've kind of seen too. That's a great point. Getting a little bit more specific, some of the things that I've seen that I've come across with challenges for people with their taxes is not understanding the backdoor Roth rules. The fact of the matter is that if you have a rollover IRA and you're trying to implement backdoor Roth, there's a pro rata rule that states that a portion of the amount that you're converting into Roth becomes taxable, even though it's already been taxed.
Right. Yep. And we see that, a lot. I know typically I defer those to you, or that's a great intro for you. It makes my life easier. But we do see a lot of times when people try to DIY this stuff,
right?
And these will be smart clients. Mm-hmm. They're just, the first thing they're doing is they might go set up a new IRA, right? A blank one, because that's what they read, and you set it up just for the purposes of these backdoor Roths, and then they'll do the backdoor and they think they're all set. But what they don't tell us is, they have 100,000 or 200,000 sitting in an IRA already,
right? Yep. Or they don't even execute the conversion. They think that just because they've made the after-tax contribution to the traditional IRA, they've completed the backdoor Roth, but that's not true. And then the account sits invested, it has gains, and now those gains are taxable. Too, when they get converted over, which isn't the point at all.
Right. And I would say, again, these are clients that we work with, but I would assume outside of that, the percent is probably pretty high of people that would do that incorrectly.
Yes. Yep. So if if you're in a position where you're thinking of doing backdoor Roth contributions, please reach out to a professional. Even if you just have questions about it, we'd rather that you ask questions. We do a free consultation or something like that, and then end up getting dinged and having penalties and misfiling your returns and things. Yeah,
I think probably our last webinar we talked about, there's levels to the tax strategies and even the financial planning strategies that we implement, and like that's not level 1,
right? No.
So it's maybe level 3 or 4. So you have to you have to be on it. You have to have a professional. You have to be looking at this stuff all year. You have to be aware of the rules,
right? And
not something you want to DIY unless you're
right. And backdoor Roth specifically is generally a technique for people who have a significantly high income because they can't do a traditional Roth
Right. Yep.
contribution, right?
Yeah.
So if we're in a situation where you are making those decisions and you end up getting taxed on a portion of the amount that's already been taxed, you're already in a high tax bracket most likely.
Yeah.
So that's a lot of dollars.
Yeah.
It's a lot of dollars.
And it's just gone. Yeah, you're not getting it back. It's not a timing thing. You're
Right.
just, you're double paying tax on
yes,
that.
exactly.
Yeah, no, that's a good point. And even, I mean, we get calls from people saying, hey, I'm going to, I'm going to do the Roth contribution this year. And it's like, you look at their income and it's like, no, you're not.
Yeah.
So, and again, I just always think about like, well, at least this person came to me and said that, but think of all the people that don't, and then they go to TurboTax or an H&R Block or something. And
yeah.
they're just going to do it. So
Yeah. One other thing before we move on, before this, we were talking a little bit about equity compensation.
Yep.
Some of the challenges that people have with making decisions about that. Could you just briefly touch on that?
Yeah. So that's another one that we work a lot with the advisors on. So someone who's in more frequent communication, especially with the wage earners or the individual tax returns, a lot of times for us, it's a client that their tax situation is very simple, W-2s and a house. But, with the exception of this equity. And so working with their advisor, they're going to know when they're granted these, these awards. And so working with them throughout the year, we can kind of strategize on like, well, when do you vest and what should we be prepared for? Are they, in the W-2 and oftentimes under withheld on, when are they going to have capital gains to pay? And so I would say on that, every situation is different.
Yeah.
So if anyone thinks that they, kind of know the rules, they don't, it's different for everyone. So definitely work with someone on that. That's where you can get the tax on that can stack up really quick.
Yeah.
The risk is big.
And to your point too about, working kind of advisors and tax accountants working hand in hand, a lot of people think that accountants are kind of the one-stop shop, right?
Mm-hmm.
Like you guys, that accountants know all of the assets and everything like that, but that's
Right.
really not the case. If there's not, in a lot of circumstances, if there's not a form for it, you might not know that it exists, right?
Right. Yeah, we'd be making a lot more money if we were the one-stop shop. You need advice from both sides. So there's
Right.
things that we see on forms that the advisors aren't going to be aware of,
Mhm.
things we talk about for taxes the advisors won't be aware of, and then definitely vice versa, things that the advisors would know that we're just not going to know. We don't
Right.
ask people how much is in your bank account and, all that
Mhm.
sort of cash flow issues, what they have going on in their lives in terms of future planning. So,
Yeah.
you need both sides.
Mm-hmm.
And then just letting them know the risks. These companies don't do a great job of advising. To go back to the equity compensation, they don't do a good job on advising these clients.
Right.
And from what I've seen, that's the same for smaller companies, but even more so in bigger companies, surprisingly.
Yeah.
So, it looks good and people think that they're just getting some stock options or, restricted stock or units, but it's not that simple and they don't tell them what to expect in terms of taxes. And it can, I've seen it go well, but I've seen it go really poorly.
Yeah, absolutely. Can we talk briefly? I've had a couple of clients this year who they've started making significant income, and it's been either, partnership income or business distribution income. Can you talk a little bit about under withholding, the risks of under withholding, and just briefly touch on safe harbor rules?
Yeah. So, for business owners, it gets tricky because a lot of time, like especially the small businesses that you and I work with, their income's so variable year to year. So you want to be withholding, as close as possible to your tax. And for business owners, that's done through, your quarterly estimates. And so you have, working with your professional, we can kind of talk about where your income's at, give you a proper estimate.
Mm-hmm.
What we do with a lot of clients, especially ones who are maybe less communicative throughout the year, is we'll give them safe harbor estimates. So we'll do 110% of their prior year tax. And again, we talk to them, right? So that has to make sense for them. If they say, no, I had a lot of income in the prior year. I'm going to, I'm taking some time off, or the business is changing, or we're investing in this or that. Of course we can adjust it down,
Right.
but yeah, the problem is if you can do that, you're avoiding interest and penalties. So if your income goes from 100 to 400, but you kind of paid in that safe harbor, you got to pay that in April, but you're not paying additional penalties on that, which is good. But then you're sitting at a big tax bill. So we kind of try to find that middle ground between what's an appropriate amount that you do want to be paid in throughout the year, but you don't want to overpay.
Right.
And of course, you never want to be paying interest and penalties on that.
Yeah. It's a tough balance to strike, especially with interest rates and high yields, personal high yield savings accounts being relatively high. People can earn good interest when they have large business distributions or a large amount of income. The money can sit in a high yield savings account and do a good job for them.
Right. Yeah. And the flip side of that is when interest rates are high in a high yield savings, I mean, the IRS is charging higher interest rates now. Of course. So, So yeah, your risk is bigger as well. Not only what you're giving up, what you could be making, but what the IRS is going to charge if you're underpaid. On that, of course, there's the estimates quarterly, but we run into a lot of small businesses or large businesses that want to, you have to extend their tax return for one reason or another. So maybe they're getting their records together, or we're waiting on a K-1 or something. And for those people, it becomes tough as well, because so the extension is an extension of time to file, not pay.
Right.
So you do have to pay in. And that's always a difficult conversation with clients. I have it weekly for sure, if not daily. They're like, well, how much do I pay in? I'm like, well, how much was your income? They're like, well, we don't know yet. That's why we're extending. And so it's just, again, this circular explanation of you have to come up with, a best guess. Some of them we pretty much can get the return done and have that amount. But for the most part, it's like you want to be as close as possible. And you definitely don't want to be under. I'd rather be overpaid, but clients don't want to give too much money to the IRS too soon.
Sure.
And then you get that return filed as quickly as possible after. Correctly, so that the money isn't hanging out there one way or the other too long.
Yeah, that is important. And it's also important to realize that, there's a lot of coordination that needs to happen. And the more information that I think your accountant has, the more successful you can be overall, right? So there's no point in holding back from your accountant. There's no point in holding back from your financial advisor either. It's the more I always tell my clients, the more information that I can have, or the more information that any of your professionals can have, the better. It just helps us to give better data,
right?
To give better advice.
Yeah, and it's kind of a no-brainer, because typically you're not getting charged for it usually.
Right.
If you connect us on an email, or your financial advisor gives us information, we're happy because it makes our lives easier. And the advisor is kind of happy to help the client for that as well, because they're getting paid throughout the year for those assets. So it's a no-brainer. And then leaving it up to the last minute, it's it's not good for anyone. And the hard truth of it is, no professional, whether it's a CPA, a financial advisor, or any other field, they're never going to care about your outcomes more than you do.
Exactly.
Right? So if someone comes to me on April 14th and I haven't heard from them all year and they're looking for tax savings, it typically doesn't keep me up at night. But that small business or that individual that, is worried about it all year, and we communicate, and they're looking for better things, ways to do things better. Those are the clients that you worry about, and you look for tax savings and those sorts of things. Yeah.
Absolutely. That's a great point. To that point a little bit, I want to kind of talk a little bit about some deductions and credits. What are some things that you think it's important for people to know that they might be missing out on? I know there were several changes to the tax code back in 2017 when the Tax Cuts and Jobs Act came out. And I still feel like clients' understanding of the tax code hasn't shifted necessarily with that, and now we're in a new legislative situation, a new political situation, that where these changes might stay, they might not. But what are some of the things that you think it's important for people to know in terms of deductions and credits?
Right. Well, I mean, you saying that just makes me think it's more about, sometimes it's a lot of things that are not deductions that clients think they are.
Yes.
So, we'll get, of course, we still get the, real estate taxes and mortgage interest and donations, medical expenses. But for the majority of clients, in New York, it's, you have to have a lot of donations or a lot of medical expenses, So ever since the SALT cap came into play on state and local taxes, you're limited on that deduction of $10,000. So with the increase of the standard deduction going up every year, which is good, but it just means less and less of those itemized deductions typically count.
Right.
So they can, they can help you on the state. So again, we still take them, we still put them in. But when clients are very excited that they, had some donations, of course it's good for the charity and it's good for everyone. But a lot of times it's not that it, doesn't affect their taxes. So kind of understanding that, it's getting, there's a lot less people itemizing than there used to be.
Yeah. Yeah.
And then, besides that, some deductions. Again, we talked about the HSA. And I think a lot of people are, you probably see this with your clients. A lot of people are afraid of the high deductible plan,
Yes.
right?
Yes, absolutely. There's a mental barrier.
Yeah.
there.
And you've probably done more calculations on it than I have. But, I know when we looked at it, depending on your out-of-pocket maxes and all that fun stuff, it's typically a better deal.
Yeah.
On top of it's more, I like the idea of the flexibility of being able to look back at the year. Do you want to save taxes? You can contribute this much. What's going on in your life? Or, I just like the flexibility. You have
Right.
big medical expenses. You can front load it and
Right.
do last year's. So, or you can do nothing, if you think you're going to have a pretty stable year health-wise.
People are often thinking only about their out-of-pocket costs as they're going.
Yeah.
So people who are on traditional health care plans who are $45 here, $45 there, they think, oh, well, if I have a catastrophic event, then I'll just pay $45 for it or whatever the copay is for that. But when you actually sit down and do the math and you consider the premiums as well, especially on the family plans for a lot of these health insurance plans, it's astronomical. You're paying more in some circumstances, you're paying more in premiums than your out-of-pocket max for these high deductible health plans. So the math is just, if you were to just pay the lower premiums of the high deductible health plan and you end up not needing any care, then you've saved a ton of money. If you end up needing catastrophic care, then you've still saved at least, $1,000 to $500 versus if you didn't have any medical expenses and you just paid the premiums for a traditional health plan. It's absurd.
Yeah. And I think, the goal is just to, like you said, I think that increase in the out-of-pocket max is probably a lot of the concern. But if you put that in your HSA, once you have that covered, that difference, then, what is there to be so worried about? And then, yeah, I think a lot of people, healthcare is going up and the premiums are going up to account for that.
Yeah.
So it's not getting better.
Right. No.
So
no.
I would say sit down with someone or if you can do the calculation, but just kind of look at the plan options if you have it. A lot of times employers will also contribute and that helps too. So that helps offset some of the costs.
It does help.
So just I would say evaluate it because the HSA, as we mentioned, it's a great vehicle for other reasons as well.
Yeah, because for anyone who's watching or listening who doesn't know, an HSA isn't like an FSA. With an HSA, any dollars that you put into the account and then you don't use, you end up keeping. So it's essentially a health IRA. You can sort of think of it that way, right? Like you can use it tax-free and penalty-free for healthcare expenses. And you get a top-line deduction. So it's a dollar for dollar reduction of your taxable income. Doesn't matter how much money you make, and it's just an incredibly powerful tool. It's a great way to save money.
Yeah, and I think some people, I think I mentioned, they use it as that retirement. And the nice thing about that is if you're then paying some medical expenses likely for something.
Yeah.
If that's coming out of pocket, as long as that plan's open, you can go and pay yourself back.
Yes.
So if you were to need cash, there's two options. You can go back and reimburse those expenses, and that would be tax-free, which is great. But the money's also there. So if you needed to take it, you do pay tax and there will be that penalty, but it's still accessible if you
Right.
were to, run into an issue, whereas
Right.
the premiums you're paying, those are gone.
Right,
Those are
exactly.
never coming back. So, yeah, it's a good one.
Yeah, I like that one a lot. And to go back to something that you talked about in terms of the charitable giving, that is a challenge that a lot of people don't understand. Unless you're itemizing, you're not going to be able to deduct your contributions to charity. If you're taking if you're taking the standard deduction, you're not going to be taking your charitable gifts. There are a couple of ways that I've seen people be able to use charitable gifts to reduce their tax liability. The first is qualified charitable distributions. If you're over age 70 and a half, then you can take a qualified charitable distribution. You distribute the money directly from your IRA, and it goes right to the charity. Generally speaking, if you're charitably inclined and you're of the age, it makes a ton of sense. It's the most tax efficient way because, again, it's a dollar for dollar reduction of your taxable income. Then also the donor advised funds, which is something that you and I have talked a bit about.
Yeah.
I like them a lot. If you're looking to make a large gift in a particular year and you're not of an age or it doesn't make sense for you to do a qualified charitable distribution, the donor advised funds essentially let you lump a ton of money into making a contribution to a charity or a nonprofit. And then it can be directed to different projects. So if you want to do something like a 5-year gift to a nonprofit, then what you can do is you can do a donor advised fund, lump all 5 of those years of dollars together, give them in 1 year, and then that would give you a better chance of being able to deduct your charitable gift. Because
Definitely.
you probably wouldn't use you might not use the standard deduction that year.
Yep. Yeah, you're lumping them into 1 year, getting
Exactly.
that benefit, because if you did split that, you may not get it. So
Yeah.
that's a good one. I mean, do you ever have clients do, the appreciated stock?
Yes.
You have clients do that?
Absolutely. Yeah. Absolutely. So it makes perfect sense if you're trying to figure out how to, if you know that you're going to be sitting on, stock that you have a very low cost basis in, and you don't know what to do with it, you're probably not going to sell it because it doesn't make sense from a tax standpoint to do it, and you're looking to gift to a charity, it makes a ton of sense to do appreciated stock because then the charity doesn't pay any tax, right? It doesn't matter what the basis is to the charity, but you get to you get to do your charitable gift, and also you don't have to realize the tax,
Right.
So the last thing that you want to do is most likely is sell a highly appreciated security and then gift the proceeds, the cash proceeds, to a nonprofit when you could just not pay tax, gift them the appreciated securities, and be good to go.
Right. Yeah. So you're potentially giving them an extra, 20 to 30%.
Exactly.
Depending on your tax brackets in federal and state.
Yes. It's about being as efficient as possible.
Yeah.
Right.
And that's a big one.
Yeah. And that's kind of how I feel about wealth management in general. Is this isn't necessarily earth-shattering stuff, right? And we're not talking about changing the entire way that you think about money or manage your money. We're just trying to help you to be more efficient. Help your money go further, and have it work harder for you.
Yeah.
Right.
Definitely.
Yeah.
I mean, to go back, some of these deductions, I think, I know we're talking about a lot of W-2 people, but even the self-employed, again, just having those records, and we always bring up, the home office deduction and mileage, and, having those things that we can add in that you kind of took the hit personally on as well, and getting to, deduct that business portion, especially when, if people don't have a separate account for their business. That's typically the first thing I advise people do when they start. But for whatever reason, some people don't. So you have to make sure that split is correct. And then a lot of times they're paying out of different personal accounts because of, maybe they had room on that credit card or whatever. But making sure that those expenses all get accounted for, which if you're doing that at the end of the year, that's 12 bank statements for however many accounts. If you do that throughout the year, it's typically an easy process or an Excel sheet, or of course you could use QuickBooks or something like that.
Yeah, absolutely. You talked a little bit before about a dependent care FSA. Could you let's elaborate a little bit on that? Because I know that a lot of the people that I'm working with, and maybe a lot of the people who are watching, are kind of at the point where they're having kids or they have kids who are in daycare. So just riff on that a little bit.
Sure. I'll be honest, we don't see it a ton for some reason. I think companies are doing it more and more with daycare costs increasing. Ouch.
Ouch.
Yeah. So with daycare costs increasing, I think people are, for some reason, under the impression they get a nice big tax credit for that. It's, depending on your income, little to nothing.
Yeah.
So the FSA allows you to, the dependent care FSA allows you to put that money away pre-tax up to $5,000 in your paycheck and then use that for daycare. So instead of your $600, credit, you can, you're getting a much larger tax-free amount. Now, the $5,000, when I look at my daycare, but it's nothing.
Right.
So that's the downside, is I think those limits should be increased. But even as they stand, it's sort of a no-brainer. And then you're still going to have enough expenses beyond that you're still likely going to get that credit. So
sure.
It's a little bit of automating as well. You're kind of putting that away through the year. You don't notice it as much, and that way you kind of have that savings. Mm-hmm. You can still use that, even if you have an HSA.
Yeah.
So there's the FSAs for healthcare, the flex spending accounts for medical expenses,
which is a use it or lose it type of account.
Correct.
Right?
Yep.
Yeah. Mm-hmm.
So you can't do both of those, but you can still have a dependent care FSA, typically with an HSA for health insurance as well.
Okay. Yeah, that was something I was not as familiar with.
Yeah, I honestly wasn't either. Like I mentioned, a lot of times, it's just in their W-2, so on the tax input, it's not complicated. But now that I'm doing it, of course that helps you learn more than anything.
Yeah, that's true, right? A lot of this comes from personal experience.
Yeah,
too.
Definitely. And it's all about, does your company offer that?
Yeah.
And so I would say if you're not doing it and you have daycare expenses, and then look, see if you have that benefit. There's a lot of benefits that some of these companies offer that you never know when you get started. If it's not something you need, you never look back at it again.
Right.
But always either reach out to your HR or look in your handbook or something like that to find out what other benefits are there, especially as your situation in life changes.
Yeah. Yeah, absolutely. One of the things that I like to talk to clients about when if we're talking about, being smart about saving from a tax perspective, how to optimize our savings in a way that also optimize our tax situation. Being aware at least of what your employer match is another good way of being smart about your savings and your tax situation. A lot of clients who are just starting out in their careers, they'll ask me, hey, how much should I be contributing? And of course, I go through the process with them of making sure that we understand what their emergency fund needs to be and things like that. But one of the first things I say is, well, at least make sure that you're getting your employer match, because you're most likely not going to get that level of return, right? So match 50% up to the first, 8% of your salary. Well, then that's essentially a 50% return on every dollar that you put into that account. Right.
Yep.
So I think that makes a lot of sense. And then also, if you're doing it if you're making those contributions on a pre-tax basis, then it's a dollar for dollar reduction of your taxable income again.
Yeah.
Right. It's an above the line deduction.
Yep.
But at the same time, it's also important, we've talked about this a little bit, it's also important to have some tax diversification in your investments, right? You don't necessarily want all of it. Of course, every situation is different, but more of the plans that I've seen, a lot of plans, I've worked with a lot of clients, and when a client has a mix of non-retirement and retirement assets, those plans tend to have more flexibility. And a lot of times they can be more successful because every dollar that they're taking out to cover an expense is not taxed, right?
Right.
They can modulate how much they need to take out of their retirement assets to keep themselves in certain tax brackets. We can do fun things like Roth conversions when they're in lower tax brackets. And so there's a lot to kind of keep in mind as we're moving through with that.
Yeah, and I think what a lot of advisors probably don't talk about, not to dig on them, but because they don't make a percentage on, but there is there's other ways to save for retirement as well, right?
Mm-hmm.
So, I mean, you and I have worked through the process together. It's, is your business valuable and how are you growing that? And,
Right.
how are you going to sell and what's it going to sell for? And how does that impact your retirement? Of course, there's real estate, which
Mm-hmm.
a lot of our clients do. And then with a lot of the high earners, they don't want to work till they're 65 anymore.
Right.
So, having that taxable investment account, even though there may be tax associated with it down the road,
Mm-hmm.
having that mix allows you to play with that and keep that rate as low as possible, potentially zero.
Yep.
But I think diversifying, and each person's different, right? Like, of course, I invest in my business, but, I also want retirement. So, what's your mix and what's your risk associated with that, and how's it going to work when you do go to retire?
Right.
Especially if you retire early.
Right.
So,
Mm-hmm.
yeah.
Yeah, I agree. I agree completely. One of the things that with some of our super high income earning clients, we've started to recommend, and not all plans allow it, but we've started to recommend looking into the mega backdoor Roth. I have heard some rumblings across our industry that the mega backdoor Roth and the backdoor Roth are kind of on the chopping block. The legislators in general, even before this most recent election, were not big fans of it. So it could go out of fashion, but a lot of employer plans, especially if you have an employer that employs a lot of higher income earners, they have the ability to do these mega backdoor Roth contributions. And essentially what it is it's the backdoor Roth, but it's within your retirement plan, right?
Yeah.
So
Yep.
you're making after-tax additional contributions in addition to maxing out. So let's say that you're maxing out your pre-tax contributions to your employer-sponsored retirement plan. Then in addition, the plan allows you to make additional contributions after tax into the plan. And then a lot of them are so well set up for it that they have automatic conversion features, right? So any non or after tax dollar that they know gets contributed into the plan, they automatically convert it to Roth. So there's a lot. And what that does is it boosts the amount that you have in your retirement savings. But the nice thing about those Roth dollars is that they've already been taxed.
Right.
They'll never be taxed again.
Yep.
So it's a super good tool and especially our higher income earners that have the ability to do that plus save in other non-retirement accounts. It makes a lot of sense.
Yeah. And I think, that's one, again, I think it's a little higher level, which is good.
Mm-hmm.
And, I try to send you a lot of clients. I think we talk to a lot of clients that think they're already doing everything they can,
right?
And their situation's pretty simple, or they contribute to their 401k, but they do want to do more, but they think that they're kind of maxing out.
Yes.
And a lot of times, whether it's these some tax strategies or things like that, the mega backdoor, they're not, right?
Right.
You're not doing it all.
Mm-hmm.
They think that they know everything, but we try. It's just outsourcing, right?
Yeah.
They're good at something else, but leave it to a professional. And if you work with, typically, like when you and I look at a client, I mean, I've never seen someone that we didn't find a lot that they could do better.
Right.
So, yeah, I think that's important, because there's always levels up that you can keep kind of going.
Yeah.
And the more you communicate, the more they're focused on it throughout the year, we can get them there.
Yeah. Yeah, absolutely. And to that point, there might even be some situations because I'm more of a generalist than like a specialist,
Yep.
I think a lot of people don't understand what financial advisors do. If I have an accountant, what do I need a financial advisor for? And we make the connections between what's happening with your taxes and what's happening with your estate and what's happening with your investments. We're general knowledge based folks who know
Quarterbacks.
We're quarterbacks.
You're the quarterbacks.
We're the quarterbacks,
Yep.
right? And we depend on kind of all the wide receivers and the linemen and the tight ends and we depend on everyone else to implement things, but we have the knowledge of how each of those pieces are supposed to work together.
Yep.
Right.
Yeah.
So there are other strategies that are important to know from like an estate planning standpoint for our higher net worth individuals. Things like potentially utilizing individual accounts with transfer on death instead of joint accounts. Because what happens is, what I've seen a lot is you have, two individuals, they have several $1 million in a joint account. Then one of them passes away. Usually the older one passes away.
Usually the husband.
If it's a heterosexual couple, it's usually the husband who passes away first. And then they get the survivor gets a half step up in the cost basis of those assets, right?
Yep.
So instead of, if someone bought a share of a company at $50 and now it's worth $250, they have a $200 gain on that share. Well, instead, with the half step up, it's half of that, right?
Yeah.
But what you can do instead is, if it's likely that one of the clients is going to pass away earlier than the other, then you leave the assets in the name of, in a solo individual account of the client who's more likely to pass away. You put a transfer on death on that, so it still avoids probate. But what ends up happening is it still transfers to the spouse or whoever it's intended to, but it gets a full step up in basis instead of getting a half step up in basis.
Right.
Right.
Yeah.
So there are all of these like little tiny things that you can do. So we're not just, even though we are focused largely on working professionals, there are still things that we can do for non-working professionals or, folks who are retired or on the cusp of retirement. There's all sorts of things that we can help with. Right.
Yeah, definitely. Yeah.
And it's fun.
Yeah. And it's not a one day thing. It's not here's a list you can do, because each situation is so specific. I think that's why we do have a lot of clients that come to us knowing that maybe they're not in desperate need, and you probably too, they don't need a ton of advice today, but they want to start that conversation
and have a relationship.
We implement 1, 2, 3, and then each year you kind of just try to get better and better and better. And even though you're getting out to the fringes, those 1%, that 1% over however many years can end up being millions.
Yeah, absolutely. As we're coming up kind of on the last 10 minutes here, I just want to pick your brain a little bit, Eric, about what your recommendations might be for, making sure that you're working with people. We touched on it briefly, but giving recommendations going forward that people can walk away with today.
Yeah, I would say, again, going forward, right, starting on the right foot. Of course, at this point, definitely wait till after April 15th. But, reach out to those professionals. If there's a CPA in your network, or if you're already working with one or with an advisor, reach out and just set that meeting and say, let's talk through some things. So an easy one, anytime someone changes a job, we tell our clients, if you're changing jobs or your life changes, you get married, divorce, send us your withholdings, send us your pay stubs. We'll look through that, talk about your situation. Do those need to be updated? Because again, we see those surprises sometimes in February or March or April, and that, they owe 10 grand or even 10 grand over withheld, which is a little less scary, but
but still a missed opportunity.
Exactly.
Right?
And so, that now they got to come up with that money. And if that's not in the account, then you got to deal with that. So, I would say reach out, just touch base with those professionals. And then I think probably a lot of the times on your side, we get clients saying that, well, I don't want to pay someone, I don't have that much going on.
Right.
I always think, like, isn't that when you want to pay someone, right? Because one, you need the advice, but two, if they're charging a percent or even a fee, why not do it when you don't have that much?
Right.
So you can implement these really in terms of dollar, you're implementing that at the lower cost before you're sitting on them. Then if you want to leave, you can, right?
Right.
So, I would tell people, like, the younger the better, the less money the better, because you're still getting that advice. And good advisors are usually willing to work with clients that they plan to work with for a long time.
Right.
So you're kind of getting that. I'll call it a freebie, but whatever you want to call it. Discounted rate for sure, with a good long-term client. So reach out. Obviously, like I said, keep good records. Save up cash, right? Because all of these opportunities, the more cash you have, the more access you have to these opportunities and to better professionals.
Right.
And then, review your withholdings. And then for those self-employed people, definitely your estimates. We get, I think I mentioned the people that, they change to self-employed, they don't tell us, so they didn't pay in all year.
Right.
And it's, it's not just income tax. You're now paying self-employment tax. So that percentage for a lot of our clients overall is definitely approaching 30 to 40%.
Yeah.
That they're going to be on the hook for.
And that's tough.
Yep.
That's a tough pill to swallow.
Oh, yeah. And a lot of these solopreneurs now, there's not many expenses for some of their income, which is good. But, they're like, I need deductions. And it's like, well, what do you do? And they just kind of sit at the computer and make a lot of money. So, the good news is that they're not spending a lot of cash on expenses. But the bad news is it's a tax problem.
Yeah, that's fair.
And then, I always say retirement, if you can, increase it a little bit each year. Mm-hmm. If you're not maxing out your HSA, keep increasing a little bit each year.
Yep.
Dependent care. And, just try to just do one thing after another and not try to do it all at once.
Yeah. Yeah. I think that's all really good advice. To go back to your point about working with professionals earlier on, I think that it makes a lot of sense. A lot of people think that they don't need to work with professionals until they reach a certain, wealth level. But that's kind of counterintuitive, because how do you get to that wealth level unless you know what you're doing? And what I say to a lot of my higher income clients is that a high income cures a lot of ills, right? Like you can make a lot of mistakes if you make a lot of money.
Yep.
And you don't feel it, right? A lot of people say, "Oh, well, I'm making, plenty of money. I don't really need to worry about it. If I'm missing out on 2 to 3% here and a couple $1,000s in my taxes, like, is it really that big of a deal?" And it's like, well, I guess maybe not really, but realistically, why wouldn't you? If it's only going to cost you a couple $1,000s to be more optimized,
right?
Wouldn't you want that rather than just wasting that money because you're not making decisions that make sense for you?
Definitely. Time value of money, right?
Right.
They're maxing out their 401k early because they know that it's going to. So why wouldn't you do any decision that's going to increase your wealth or limit your liability?
Right.
1, 2, 3, 4%.
Right.
The sooner the better, because it's going to compound. And you do that every year, it's going to compound over, 30, 40 years.
Right.
Yeah.
Yeah, absolutely. Well, any final words before we drop off here?
No. I would just say, if you have questions, reach out to us. After April 15th.
For me, you can reach out at any time. I'm not too busy during the filing season. Do you want to let people know where they can find you?
Yeah. Yep. Dauphin Fantacone CPAs, df-cpas.com. Yeah.
You're on LinkedIn.
I'm on everything. Yeah.
You're
find
everywhere.
me through John's post. Yeah. It's hard to not find me. So yeah.
That's true. I've even found out some people that I know have found you without me even telling them about you.
Yeah.
So that's pretty cool.
Yeah. We try to keep it a secret, but
yeah.
Yeah.
Yeah, absolutely. And of course, if you have any questions, you can reach out to me, jhowe@gencapmgmt.com. Our website is gencapmgmt.com. And if you're on LinkedIn, Instagram, or Facebook, you probably can't miss us, but feel free to follow us there. Be sure to sign up for our email list so you never miss any information from us. But other than that, Eric, thank you so much.
Thanks for having me.
For doing this.
Yeah, it was great.
Thanks for making the trip. Really enjoyed it. And I'm sure that we'll be talking soon.
Definitely.
All right. Thanks.